In the New Testament, there is a passage that states, "For whoever has will be given more, and they will have an abundance. Whoever does not have, even what they have will be taken from them." Matthew 25-29. This passage reveals that even in ancient times, our ancestors observed what we now call the effect of compound interest. Although the famous saying compound interest is the eighth wonder of the world is often attributed to Albert Einstein, there is no historical record confirming that he ever spoke those words. In truth, many great minds throughout history never uttered the famous quotes linked with their names. Yet because of his genius and the endless inspiration he provides to young scientists, Einstein continues to earn interest from these well-known adages. Hidden within this familiar pattern is one of the most powerful laws of the universe, the law of exponential growth. In 1906, the physicist Alfredo Pareto introduced what we now call Pareto's principle, or the 80-20th rule, after discovering that roughly 20% of the population in Italy owned 80% of the country's real estate. This classic pattern, where a small minority achieves results far beyond the rest, appears in many fields. For instance, a handful of books may dominate sales, while a few actors or athletes earn astronomical salaries compared to their peers. In business, a few companies may hold near-monopolistic positions that yield enormous profits, while others struggle just to survive. It is no wonder that this rule can be unsettling, as it reminds us of the inherent inequality in society. For whoever has will be given more, and whoever does not have, even what they have will be taken away. Perhaps Einstein never actually said compound interest is the eighth wonder of the world, but the eighth wonder is no exaggeration when describing the power of exponential growth. With this force at work, Warren Buffett has risen to become one of the richest individuals of all time. This article assumes that readers already have a basic understanding of compound interest. For those who are unfamiliar with the concept, further resources explaining its definition and calculation methods are highly recommended. This topic alone deserves an entire separate discussion before you continue. The power of compound interest. Venture capital has experienced remarkable growth in recent years as more technology startups emerge, with the goal of creating enormous value by fundamentally changing traditional ways of life. In a typical venture capital firm, the general partners GPS make the final investment decisions and are fully responsible for the fund's performance. They raise capital from wealthy individuals and institutions known as limited partners (LPs), and then deploy that money in search of the next groundbreaking company. Although the GPS typically invests some of their own money, the vast majority of funds come from external investors. VC funds generate returns when the startups in their portfolio are acquired by large corporations, or, even better, when they successfully launch an initial public offering (IPO). Given the nature of startups, venture capitalists expect that early on the fund will not produce profits, because nearly every startup, with a few rare exceptions, must burn cash in its early years to build a sustainable growth model. With this in mind, VCs hope that while the early years might be challenging, the overall value of the portfolio will skyrocket once one or more companies achieve the breakthrough needed to trigger exponential growth. Reality, however, is often harsher than hope. Most startups fail, and as a result, many venture funds are created and dissolved because all the companies in their portfolios end up underperforming. Even those who understand the 80-20th rule and the uneven distribution inherent in exponential growth often underestimate just how crucial the differences between startups can be. Paul Graham, co-founder of the renowned startup accelerator Y Combinator, once wrote in his blog Black Swan Farming that when you interview a startup and think they seem like they'll succeed, it is not merely about the chance of success on a micro level. Rather, the only kind of success that matters in venture capital is whether that startup will succeed in an extraordinary, transformative way. In any given day, you might meet several exceptionally talented 19-year-olds whose chances of small-scale success seem slim, but what truly counts is whether one of them will achieve an explosive, monumental breakthrough. There is only one type of success in venture capital. Either a startup rockets to unbelievable height, or it does not. If a startup manages to launch on a metaphorical rocket to the moon, then the returns can be enormous. even if every other startup in the portfolio fails. Although this may sound harsh for founders who do not achieve unicorn status, the undeniable truth is that the world is relentlessly governed by exponential growth. Even the distribution of fame can be affected by compound interest. Consider that while many brilliant scientists such as Niels Bohr, Paul Dirac, Richard Feynman, and Erwin Schrödinger made groundbreaking contributions to physics, public memory has long elevated Einstein to the status of a singular genius. With the force of compound interest, Einstein's reputation as the iconic genius only grows stronger over time, while other equally talented figures remain largely unknown to the broader public. The double-edged sword: not everyone truly understands the power of compound interest, and even among those who do, very few possess the patience or mental fortitude to fully harness it. In fact, there appears to be only one person in the world who has mastered this principle: the legendary Warren Buffett. His steadfast rule of never liquidating his investments even after holding them for decades is the clearest demonstration of how deeply he values the benefits of compounding. An exception to this rule is when an investor has a specific financial goal, say, saving up predetermined sum to make a major purchase and decides to exit the market upon reaching that target. Many traders embrace the popular saying on Wall Street, "You never go broke taking a profit." Yet even among seasoned traders, figures such as Stanley Druckenmiller and Paul Tudor Jones have pointed out that this mantra has often led to failure. Locking in small gains while letting losses run is not a sustainable strategy. In long-term investing, selling a winning asset prematurely means losing out on the extraordinary benefits of compound interest, while stubbornly holding on to underperformers only compounds the problem. If compound interest is indeed the eighth wonder of the world for those who know how to harness it, then opposing its force can be considered the eighth sign, to be added to the traditional list of deadly sins, which include arrogance, laziness, gluttony, envy, hatred, greed, and lust. In the realm of finance, no mistake is as grievous as directly confronting the power of compounding. Ultimately, whether you recognize it or not, compound interest will either work in your favor or, if thwarted by frequent trading, excessive fees, and high taxes, will gradually erode your capital. High-frequency traders, for example, often fail to realize that with every trade, transaction fees and taxes compound against them. Although these costs might seem small initially, over time, they accumulate into a substantial drain, much like how compound interest can work wonders when it is allowed to compound in favor of an investor. If you have been following recent financial news, you may have noticed that Elon Musk has become the richest person in the world, surpassing even the combined fortunes of Bill Gates and Warren Buffett. The same exponential force that helped Buffett build his wealth is now propelling Musk through the meteoric rise of companies like Tesla and SpaceX to new heights. Just a few short years ago, Buffett's net worth dwarfed Musk's, but a period of sustained, dramatic growth fueled in part by supportive monetary policies completely reshaped the landscape. In a nod-to-cinematic lore, consider the immortal line from The Godfather, "I'm gonna make him an offer he can't refuse." In investing, that irresistible offer is the opportunity to ride the compound interest rocket all the way to the moon. Applying compound interest in practice, Charlie Munger, vice chairman of Berkshire Hathaway and longtime partner of Warren Buffett, once said, "The first rule of compounding is not to interrupt it unnecessarily." In other words, unless you have a specific financial target that forces you to liquidate an investment, you should never consider selling an asset that is steadily compounding. Because of the exponential nature of compound interest, breaking up a long-held position can have enormous opportunity costs. The gains from the first 10 years of compounding can pale in comparison to those achieved in the subsequent decade. Here are 3 key rules for leveraging the power of compound interest in your investments. 1. Rule 1. Extend your investment horizon. Once you have identified a company poised for strong growth over the next 5 to 10 years, the most critical decision is to hold that investment for the full duration of its potential. Do not disrupt the compounding process unless you absolutely must. 2. Rule 2. Never work against compound interest. Avoid unnecessary trading and minimize costs such as margin interest, transaction fees, and taxes. While these expenses may seem trivial in the short term, over time even small, recurring costs can significantly erode your capital. 3. Rule 3. Follow the wisdom of Warren Buffett. As Buffett famously said, time is the friend of the excellent, but the enemy of the mediocre. The power of compound interest can only work to your advantage if your portfolio is filled with high-quality companies. If your holdings consist largely of speculative penny stocks or questionable ventures, do not be surprised if your results are lackluster. A practical strategy is to study the portfolios of major U.S. institutional investors like Vanguard or BlackRock, whose selections are typically based on stringent long-term criteria. The power of compound interest in investing and in life is indisputable. Those who understand and harness this principle will enjoy its bountiful rewards, while those who ignore it will eventually pay dearly. As a well-known military adage goes, never fight a battle you cannot win. In the world of investing, a battle you cannot win is one in which you choose to confront the unstoppable force of compound interest rather than letting it work for you.